Good afternoon and welcome to day 27 for managerial accounting in the fall 2022 semester. We are really getting very close to the end of the semester. The chapter 27 exercises will be due tonight because we'll be finishing chapter 27 today. We'll be picking up with exercise 6. So you should have your Cengage exercises open and ready to go to exercise 6. And then the chapter 27 problem will be due on Tuesday. Next week, we'll be covering chapter 28. And as I said, Tuesday, this past Tuesday, in class on Tuesday, we'll need to decide if we want to just power through chapter 28, which can be done in one day. It's pretty quick, but it certainly can be done. It's been done before. And so I'll need to know on Tuesday whether we want to do chapter 28 all in one day or just split it between 2 days as we have been doing with some of the other shorter chapters. And then regardless of whether we have chapter 28 covered all on one day or not, none of the due dates will change. So the chapter 28 exercises will still be due on Thursday. The problem we do on Tuesday, remember Tuesday is that optional review session. It will not be on campus. It will be on Zoom, just like all of the other review sessions that we've had this semester. So we will meet on Zoom if you choose on Tuesday the 13th at our regular class time, 1:30 until we're done. And I would expect that in that review session, we'd be going over the practice set for exam 4. But of course, we can talk about anything that anyone wants to talk about who comes to that review session. So no on-campus class for this class on Tuesday. It only affects this class. Obviously, you may have other classes. Tuesday is still officially a class day. And then by Friday the 16th, at the end of the day, everything that you want included in your grade needs to be submitted either in Cengage or in Blackboard if it's your project. And so that includes exam 4, but also any other outstanding work that maybe you've worked on but haven't hit submit for grading. All of that needs to be in by the 16th. After the 16th, anything that hasn't been submitted will be entered as a 0 in the Brightspace gradebook to calculate your final grade. The final grades are then due on Monday, December 19th. So any questions about any of that? So just a reminder that there were a couple videos in the reference materials folder for chapter 27 that I asked you to watch on your own. We ended class early on Tuesday, so to allow you the time as part of class time to watch those 2 videos related to Toyota and their implementation of the concept of lean manufacturing. Before we start the new material for today, does anyone have any questions, anything you want to talk about from the first half of the chapter that we covered on Tuesday? So we really talked about the importance under lean manufacturing approach to reducing or eliminating waste. Anything that doesn't add value to the customer is extra cost without any additional revenue. And so we're trying to cut down on that. We looked at one exercise that really displayed the nimble or efficiency of lean manufacturing, of setting up our work cells or processes so that they are more efficient with less idle time, less transportation time we saw. And one way of really doing that is by reducing batch sizes. So ideally the batch size of 1 would be perfect, but sometimes that's not achievable or you may lose some efficiencies by cutting things down to that bare bones. But the exercise we looked at on Tuesday, where we went from a batch size of 45, so that any given time, 44 of the items are sitting there waiting while 1 is being worked on. And we went from a batch size of 45 down to 3 and saw how much more efficient that was in terms of the processes. So what we're going to start with today, if there aren't any questions, we're going to start with exercise 6 in just a minute, and this relates to lean accounting. So as I mentioned on Tuesday, the lean principles apply to every area of the business. They can be applied in a service organization, just like in a manufacturing firm. And so our accounting systems are also ripe with opportunities to become more efficient and therefore more cost effective. So the focus of lean accounting is to reduce any unnecessary transaction, combining accounts when we can. And so as we talked about on Tuesday, if one of the goals of lean manufacturing is to implement the idea of pull through production rather than push through production. So we're producing because we have a customer. That tells us right there that we should have less of all types of inventory. Raw materials, work in process, and finished goods should be minimized, ideally eliminated. But we know that we don't live in a perfect world, and so we're just looking to reduce that as much as possible. And so if those accounts are going to be very low dollar, they're never ideally going to have much in them at the end of a period, it might make sense for us to combine the raw materials and the work in process account and therefore reduce some of the transactions that we're reporting or recording. Also, just like we did when we talked about about process costing in chapter 17, I think that is, in the process costing chapter, we really used the term conversion costs when we meant the combination of direct labor and overhead. And so in lean accounting, using that term conversion cost to include multiple different costs also saves us time and effort, and it makes us more efficient. We talked about in the activity-based costing chapter, we talked about the fact that we're able to, when we use activity-based costing, we're able to trace many more of the costs that under traditional approaches we call overhead, and it can include, a large number of different types of transactions, different costs. If we use activity-based costing, if we're more aware of where our costs are coming from, we can trace them directly to the product more efficiently. And so things like indirect labor or indirect materials might actually become a direct traceable cost, traced directly to the manufacturing cell. It gives us a lot better handle on what our costs are for making a specific product, which, as we talked about in the activity-based costing chapter, allows us to price our product better. But in the context of this chapter, it also allows us, if we know where our costs are coming from, it allows us more a higher likelihood that we can actually reduce or eliminate some of those unnecessary or non-value adding costs. And so that's an important piece of lean manufacturing as well, tracing that at least some of that overhead directly to the product or to the work cell. Makes us more efficient, more aware of what those costs are, so that we can target any inefficiencies for elimination. Okay. I described for you on Tuesday the idea of back flush costing, and I used that term at the time. So with pull through production, if we are going to have very little inventory at the end of the accounting period, it makes sense for all of those costs to start where most of them are going to wind up at the end of the period anyway, which is in the cost of goods sold account. And so if we do that, we eliminate a whole bunch of transactions within our accounting records, moving materials into the materials, and then into work in process, and then into finished goods, and then into cost of goods sold. At the end of the period, then we simply review all of the costs and say, did we really sell all of this? And if not, we might need to push backward onto the balance sheet those costs for the products that are either still in process or are finished goods but have not yet been sold. So again, it cuts down on the high number of entries that we're making, that when all of those costs, we know where they're going to end up, most of them at the end of the period anyway. So why not just start them there? I think that's intuitively appealing. If you're wondering, okay, why didn't we just do this in the first place? If you're saying this is better, this is more efficient, this is lower cost, why did we learn the other way, the traditional way of doing this, starting in chapter 15? And my answer to that is, one, not all companies do it this way, but two, I think it's important for you to understand what's happening in the manufacturing process. And it is the traditional approach to go through each one of those steps. If a company is not using lean manufacturing, you'd end up creating more work if you tried to implement lean accounting principles in a system that's not using lean manufacturing principles. And so it is important to understand the traditional approach, the more step-by-step going forward, as opposed to what I'm describing here, which is we start with the end in mind and then move things backward at the end of the month if needed. Okay. So we talked on Tuesday about just in time, the concept of, we think of it, when you hear that term just in time, people generally think you're talking about just the raw materials arriving just in time, but it really applies across the board to the way we do business in a lean environment. And that's why it can be used not only by companies that are making a product, but also by merchandising companies and service companies as well. Okay, so let's go to our first exercise for today. And that is, that is exercise 6. Westgate Incorporated uses a lean manufacturing strategy to manufacture DVR players. The company manufactures DVR players through a single product cell. The budgeted conversion cost for the year is $600,000 for 2,000 production hours. Each unit requires 21 minutes of cell process time. During March, 500 DVR players were manufactured in the cell. The materials cost per unit is $60. The following summary transactions took place during March, and we are asked first to calculate or determine the budgeted cell conversion cost per hour and the budgeted cell conversion cost per unit. And then we're going to journalize the entries for 1 through 4, the things that happened during the month of March. So I get my calculator ready here. And get my annotation tool so I can write on the screen for us. So the first question, the first task is to determine the budgeted cell conversion cost per hour. So we have 600, here we go. We are told that we have $600,000 budgeted, and that is for 2,000 hours. And so the budgeted conversion cost per hour would be $300 per hour. We are then told that each unit is going to take 21 minutes of cell process time. So 21 minutes per hour. Whoops. Let's see. How do I do this? Let's find to make it easier to write on the screen, let's find the cost per hour first, or excuse me, the cost per minute first. It's easier for me to write it out that way. So $300 per hour divided by 60 minutes is $5 per minute. And then it's going to take 21 minutes. We budget, we plan on average. And so that's $105 per unit. So any questions on that part? I think sometimes it takes me longer to write it out than it does to just punch it into your calculator, I'm sure. Okay, so we have those values. We expect to spend $105 per unit on the conversion cost. And we know that that conversion cost is going to include the direct labor and the overhead. So the first thing we're asked to journalize for Part C is materials were purchased for the March production. And so with our combined accounts of raw and in-process inventory, see, materials cost is $60 per unit, and we are going to make 500 units. Whoops, there we go. So 500 units at $60 each. Under the principle of just-in-time inventory management, we're only going to purchase the amount that we need for the current production. And it doesn't say how we paid for them, but I don't see an option there for cash. So I'm just going to assume that we bought them on credit from our supplier. And so we already have saved one entry because we didn't put them into the raw materials account and then make a second entry to move them into work in process. Under just-in-time principles, under lean principles, if we are only buying the materials that we need for current production, we might as well just make one entry rather than two separate entries. The second item then is that conversion costs were applied to production. So we made 500 DVRs, and each one of those DVRs costs $105 as far as conversion costs. So that total is $52,500. And we are, again, going to save some time by applying them directly into the new combined raw and in-process inventory. So we now have in that raw and in-process inventory account all of the materials, the direct labor, and what we have called overhead. So now that combined conversion cost. So in number 3, it says 500 DVR players were assembled and placed in finished goods. And so we move them into finished goods from raw and in process, and that's going to include all of those costs that we have put in there thus far. And so our understanding at this point is we don't have anything left in the traditional work in process account. Everything we were working on has been finished during the month of March. So at the end of March, we no longer have anything in process. Now that's, that's fine. But a nice goal to have, but it's not necessarily realistic that just because the calendar shows it's the last day of the month, we don't have anything still in process. But that's the assumption we are making here for the sake of simplicity. And then in number 4, it tells us that we sold 480 of those DVR players, and we charged our customers $240 per unit. How much did it cost us to make? The $105 in conversion cost plus the $60 for materials. So the cost of goods sold is a $165, but the revenues are $240 per unit. Just a bit of a review from financial accounting. If the company uses a perpetual inventory system, there's actually a 2-step, 2 entries to record the sale. We have, whoops, sorry, wrong one. We have to record the revenue part, but we also have to report the cost of goods sold piece. So the revenue is based on the $240 that we're charging our customers for those 480 units. But the cost of goods sold is based on the combination of the direct materials at $60 plus the conversion costs at $105 that we calculated up above. If the company did not use a perpetual inventory system, if they used a periodic inventory system, the second entry that we just did would not be needed. Instead, at the end of the period, we would simply calculate the cost of what we sold based on what we have left. And so this is not the concept of backflush costing that I was talking about. This is a leaner process, that is, it is more efficient. It does reduce some entries, but it's not quite as efficient from the accounting standpoint as the idea of backflush costing, putting everything right into cost of goods sold and only moving out of cost of goods sold what you have left at the end of the period. This still had us use a little bit of the traditional approach. The improvements here were that raw and in process were combined. So we saved 1 step there, cut those number of steps in half. And our conversion costs were applied directly to the raw and in process, rather they're traceable directly to the product rather than being allocated in some arbitrary way out of our overhead account. So any questions about that exercise and what we did there? All right, let's keep going then. And I am going to ask you to try this one on your own. I'm going to pause the recording. So this is very similar to what we just did in exercise 6. I'm going to pause the recording. I'll do mine on the screen, and I'll ask you to try this on your own. And if you're watching on the recording, once you have answered your questions, you can use the check my work button and then restart the recording, either for clarification or when you are ready to move on. Okay, so we journalized the 4 entries. We purchased materials for 2,000 speaker units at $48 each, which I misread initially. So the $48 is up there. We then added conversion costs for 1,800 speaker units, and the calculation of the conversion cost is right here on the screen at $25 per unit. So that's another $45,000 added to that account. Of the 1,800 speakers we were working on, we finished 1,700 at a total cost of $48 for direct materials plus $25 for conversion costs, or $73 per unit. So we moved those to finished goods, and then we sold 1,600 of those. The selling price is $90. And so that's the basis for the sales number. And then the cost of goods sold is the $73. So then to figure out what was left, there's a couple different ways you could go about that. You could do a T account. You could just analyze these entries. So 96,000 in materials plus 45 in conversion costs minus 124.1 tells us how much is left in the raw and in process. And for finished goods, we had 124.1 finished, but then we sold 116.8. So what's left in finished goods are the 100 units. And I put those, whoops, I put those numbers in backward. Do that again. So what's left in finished goods are the 100 units at $73 each that we haven't sold. And what's left in raw and in process is 200 units of direct materials plus 100 units of direct materials and conversion costs. So there were 100 units that we started but did not finish, and 200 units of materials for units that we haven't started. So in the past, or under traditional approach, the 200 units of direct materials at $48 would be in a separate inventory account called raw materials or direct materials. And the in process would include only the 100 units we're still working on. Okay. And I asked in the classroom if there were any questions before I restarted the recording, and so we'll move on. We go back to oops. So as you may have seen in the PowerPoint before we went to the exercises, one of the focuses for lean manufacturing or lean principles is a focus on non-financial measures, including things like quality, cost of quality, counting the number of defects in our production process, looking at things like customer satisfaction to see where we can improve. And so those are things that are non-financial measures. So counting the number of customer complaints or counting the number of quality defects are non-financial, but they have a financial implication for us. And so it's important for us to be measuring that and using that to help us improve our performance. So here are some examples of non-financial performance measures that we may be using, maybe tracking to help us improve our results. So lead time, value added ratio, we looked at those last class. We talked about setup time. How many times does the production line get stopped to fix a problem? So one of the things I mentioned on Tuesday is under lean principles, we're empowering our workforce to make their own adjustments, if you will. So if they see something wrong, they can actually stop the production line and get that fixed before it becomes a much bigger issue. You know, if we notice, for example, that there's a quality defect, we don't want that to end up in, you know, every single unit that's produced. So we're going to stop the line, fix the quality issue, and then move on. How many units are scrapped? Are looking at things like on-time delivery, on-time performance is a big metric. Number of failed inspections. So that means that either it got to our inspectors and it failed, or even worse, it got to our customer and it failed their inspection. So we definitely want to keep any errors internal if we can. We don't want them to be caught by someone external to the company. So you should be familiar with the term KPI, meaning key performance indicators. That's a very common expression. We talk about KPIs here at JCC, including things like number of semesters to graduation, number of excess credits that students took before they graduated, how many students are successful each semester or from fall to fall, how many persist in pursuing their goals. So KPIs are a very good measure, and they can include financial metrics as well as non-financial metrics. So it's funny to think of accountants. Why are accountants keeping track of the non-financial metrics? I think it's because frequently there is a very clear and direct connection between non-financial and financial performance, but also, it is the accounting department that's used to measuring and keeping track of information for a company about performance. Let's see. So we're going to talk about cost of quality and how do we represent that and how do we analyze that for a company. So there are a number of different categories that can be identified in terms of the cost of quality. One is prevention cost. Now, prevention costs are usually, if we incur those prevention costs, they save us in other costs down the road. So that includes things like when I mentioned, shutting down the line so that there isn't a bigger impact of maintaining our equipment, of keeping, kind of like getting the oil changed in your car rather than waiting until something even worse happens. You spend that little bit of time and effort and money up front, and it saves much bigger costs down the road. Controlling vendor quality. So maybe you have a system that approves vendors. So when you're getting your raw materials, you can trust them, you form relationships with your vendors. Making sure that there is a good quality training program for our employees so that they know what they're doing and what to avoid. Other costs of quality include appraisal costs. So having a quality inspection team to begin with costs money. So how much additional cost does that add? Cost of inspecting and testing don't actually add value to the customer. So just like everything else we've been talking about so far in this chapter, we want to reduce or eliminate those costs wherever we can when they're not adding value. So I'm not suggesting that there's no reason that we should be inspecting or testing our products before we send them out, but ideally we want to keep those to a minimum because we've empowered our workers to make sure that they're each producing a quality product. Internal failure costs of scrap and rework. So, occasionally errors do get through or defects do get through, and they're caught by that appraisal team, the quality inspection team. And did we have to throw out the product, or were you able to fix that error and then have it be a fully 100% satisfactory product? And I already mentioned that external failure costs, and that might be the most costly, the one that we most need to avoid, in part because it increases our costs, but it can also make us lose a customer, right? So we want to make sure that the product is good before it gets to our customer. But anything that is out to the customer before the defect is found is going to be a significant cost, in part because of the Now we need to maybe get it returned to us and fix it, but also the damage to our reputation and the potential damage to our customer relationships. Okay. Okay. So you can see in this graph as our prevention and appraisal, the things that we do internally to prevent poor quality. As we spend more on that, we're going to see less and less of the other, those costs of having poor quality. The internal and external failure is going to come down as we increase our good units and increase our spending on those upfront. So as I've been trying to suggest, we'd rather spend our money and put our focus on those upfront prevention approaches rather than having to deal with the actual defects later on. There's definitely a very good trade-off there. As we spend more on preventing, we have fewer defects, and it makes, it's going to make our customers happier as well. Give me 1 second. I want to see what our okay. So our next exercise, I'm going to ask you to complete on your own. I'm going to jump ahead a couple slides to show you. Okay. So exercise 7 is like a couple exercises that we talked about on Tuesday. It is simply a multiple choice question, but it is related to the concept of a Pareto chart. So what you see here is a bar graph. It's a specific type of bar graph called a Pareto chart, where we typically the Pareto rule says that 80% of the cost is associated with 20% of the problem. So that you may have heard that that 80-20 ratio or relationship in other contexts as well. But in our bar chart, in a Pareto chart, and this is showing the cost of quality in, what is it, like 10 different categories of quality costs. And the idea of a Pareto chart, again, it's a bar chart. You notice that the categories, and this is relevant if you've taken a statistics class, the categories, the bars do not touch each other intentionally, because that would imply a continuum. And these are not continuous values. These are discrete values along that X axis. We line them up from highest cost to lowest cost. And our focus, the usefulness of this chart is it helps to draw our attention to those, what we might call the low-hanging fruit. So how do we improve how do we cut down on our cost of quality? We probably want to start out by focusing on, in this case, the rework that is by far the highest cost item for us. There's probably some pieces of that rework where we could save money. And again, back to that, to the concept that I was showing you on that previous slide, maybe if we put more money into prevention. So here's our preventative maintenance in this light blue, and materials inspection and assessing vendor quality. So these things where we're not spending a lot of money are the things that could prevent this rework and warranty work and disposing of scrap and rejected materials. If we spent a little bit more money down here, the idea is we could probably save a lot more money up here. So how do we cut down on rework? Well, we make sure it doesn't get done incorrectly in the first place. So I've just described to you what a Pareto chart is, what it should look like, how it should be arranged. And I'm going to ask you to complete exercise 7 on your own, because as I said, it's simply a multiple choice. It shows you 4 graphs and gives you a table of information. It shows you 4 graphs, and you have to answer which one of those 4 graphs actually is the correct representation based on how I've just described the Pareto chart. I'm going to go back up here. So the next exercise we're going to do together is exercise 8, and it is a cost of quality report. So you can see a quality control activity analysis here on the screen. And so you, for each one of the quality control activities, in our exercise, we're going to be assigning it to one of the 4 categories that we just discussed. Prevention, appraisal, internal and external failure. And so we're going to assign the appropriate category to each one of those, and then summarize the costs for each one of the 4 categories into a report, and then answer some questions. So let's go to that next exercise. Again, skipping over exercise 8 and going to exercise 9 in the cost of quality report. Meeker Solutions Incorporated manufactures memory chips for personal computers. An activity analysis was conducted and the following activity costs were identified with the manufacture and sale of memory chips. As I said, the first thing we need to do is identify the cost of quality classification for each activity. And so we'll do that first. Then we're going to prepare a cost of quality report that takes the information we have here, summarizing them based on the 4 categories, and then calculating as percentage. And then we need to answer some questions. And I'm recalling that there's something in part C that is incorrect. So we're going to have to, I'll tell you what the book or what the answer is. It's marked correct, but as we go through it, we'll see that one of them is actually, at least one of the answers is not correct based on the information up here. And I can't remember off the top of my head which one it is. I just know from last semester when I used this same exercise that there was something wrong with it. I think we reported it. Maybe it's been fixed, but we'll see. So the first quality activity is to correct shipment errors. So of the 4 classifications, which one would that be? So it was shipped out to our customer incorrectly. It was brought to our attention that, hey, that's wrong, and we had to fix it. So which one would that be? External failure. So that's the one that we are the most concerned about because of the other implications that it might have for the future of our business. How about disposing of scrap? So it was detected that there was a defect in the inspection stage, and we had to get rid of some of the product because it couldn't be brought up to the quality standards. Internal failure. So we didn't prevent it from happening, but at least it didn't get to the customer. How about emergency equipment maintenance? So we've talked about, I'm going to jump down here to preventive equipment maintenance is part of the prevention piece. But if there's emergency equipment maintenance, that means that our prevention piece didn't work. And so we, after the fact, had to fix the equipment. Also an internal failure, I would agree. Employee training would be prevention. Final inspection. So that's checking to make sure that everything's okay. That's part of the appraisal process. Inspecting incoming materials would also be part of the appraisal process. Processing customer returns. So the product got out to the customer, something was wrong with it, they chose not to keep it, they returned it. That would be that external failure category. Scrap reporting is the internal failure, just like disposing of scrap. Supplier development would help us to prevent future problems with our materials not being up to standard. And warranty claims, obviously then an external failure. So in the next part, it asks us to prepare a cost of quality report. Again, it's summarized for all of those 4 categories. The sales for the period were $4 million. And so the total quality cost is going to be $1 million. That's from here. Whoops, that's from here. The percent of total quality costs, and is going to be what percent of those, of each one of those costs is of $1 million. And then the percent of total sales is going to be the dollar amount from here divided by the 4 million in sales. And so we know that the total is going to be 25%. We spent 1 million on quality costs out of the 4 million we had in sales. 25% of that went to cost of quality. And because the rest of these 4 rows are simply math related, just punching in the calculation into your calculator. I'm going to pause the recording. But as I said, what we want to do is take, for prevention, we're going to take the dollar amount for prevention here, 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 add those up and enter that total here, and then find the percent of the 1 million and the percent of the 4 million. So I'm going to pause the recording and let you do those calculations and go ahead and hit the check my work if you want to before you restart the recording, and we'll pick up with letter C when we're done. Okay, so we have all of our figures in there. I checked my math to make sure that the totals for the quality cost column did equal the $1 million. So we had included everything. The percent of total quality cost, again, added up to the 100%. And then as long as we rounded correctly, the percent of total sales should add up to 25% as well. So here's the thing that I was mentioning. I was remembering that something was wrong. And it's this very first sentence, in part C, the category with the fewest number of quality activities is, and you can see that there are 3 for prevention, 2 for appraisal, 3 for external failure, and 3 for internal failure. So the answer should be appraisal. There are only 2, but the book thinks that the answer is prevention costs. So the real answer should be appraisal, but unless they've fixed it since last semester, the book thinks the answer is prevention costs. The reason they're pointing that out.
It seems like what I guess like what they were trying to ask is which is like the lowest percent of quality costs, like the least cost.
Right, and so it says fewest number,
Right.
but what it means is lowest cost.
Right.
So yeah, thank you for pointing that out. Yeah, so it is the phrasing of question or the sentence that makes the answer misleading or wrong. So the fewest number of quality activities, what it really should say is the lowest cost, because prevention, they are spending the least on prevention. What did we already say about that? That's where they should be focusing their money, because if they can put more effort into prevention, they can, we hope, we should be able to avoid some of those higher cost, higher ticket items down the road. Nearly 50% of the quality activity costs are external failures, which we said are the most damaging to our company in the long run. The highest single cost is warranty claims, which is of course an external failure. Disposing of scrap, emergency equipment maintenance, and scrap reporting are all internal failures. And so again, please go with the understanding that the category with the least expense or the least cost associated with it, which really should be the one with the most cost. That's where we should be putting our efforts. Whoops, I said internal failures. I clicked the wrong one. Apologize for that. Okay. Any questions so far? Okay, let's move ahead to our final exercise for today. Process activity analysis for a service company. Statewide Insurance Company has a process for making payments on insurance claims as follows. First, they receive the claim, then they adjust the claim, and then they pay the claim. An activity analysis revealed that the cost of these activities was as follows. Receiving, adjusting, and paying. We spend the most money on adjusting the claims. This process includes only the cost of processing the claim payments, not the actual amount of the payments themselves. The adjusting activity involves verifying and estimating the amount of the claim and is variable to the number of claims adjusted. The process received, adjusted, and paid 2,000 claims during the period. All claims were treated identically in this process. To improve the cost of the process, management has determined that claims should be segregated into two categories: claims under 1,000 and claims greater than 1,000. So I just want to show you something mathematically here. So if we're spending $260,000 adjusting the claims, and that was for 2,000 claims, we're spending $130 per claim to adjust the claim. Okay. Claims under 1,000 under the new process, claims under 1,000 would not be adjusted, but would be accepted upon the insurer's evidence of the claim. So in other words, they're going to avoid spending this $130 extra for a small claim. They're just going to, if you provide evidence that it happened, then we're just going to pay your claim rather than going through the adjustment process in order to save that $130 per claim, because it said that the cost was variable to the number of claims adjusted. So those are not fixed costs, those are variable costs. And if we don't adjust the claim, we don't have to incur that $130 in claim, or excuse me, adjustment costs. Claims above $1,000 would still be adjusted though. It is estimated that 80% of the claims are under $1,000 and would thus be paid without adjustment. It is also estimated that the additional effort to segregate claims would add 10% to the receiving claim activity cost. Develop a table showing the percent of individual activity costs to the total process cost. And so we're going to do this first for we're going to do this first for the initial information based on the current process. We spend $120,000 on receiving, And these are the data that were provided to us in the exercise. 260,000 on adjusting and 120,000 on paying the claims. And so that's the total of $500,000. Calculating those as percents then. Receiving and adjusting would each be 24%. That would make receiving and paying would be 24%. That would make adjusting 52%. And so you can see that, again, more than half of the money that we're spending is on adjusting the claims. So if we can reduce that by 80% by not adjusting the large claims, even though we recognize that receiving the claim, the cost is going to go up by 10%, it's very evident without even putting numbers to it that this is going to be a winning proposition for us. So determine the average total cost per claim, assuming 2,000 claims, so $500,000 for receiving, adjusting, and paying the claims without taking into account the amount of the actual claim is $250 per paid claim. Under this process, all of the claims are treated equally or identically. There was no effort to segregate them based on whether, the size of the claim. Next, we're asked to prepare a table showing the changes in the activity cost as a result of the changes proposed by management. So prior to the improvement, we were spending $120,000 on receiving the claim. We know that's going to go up by 10%. So take that 120,000, multiply by 110%. And the increase, so it asks us to show a cost as a negative. That's why that word cost is in parentheses. So saving, if it's a savings, we're going to show it as a positive. If it's an additional cost, we're showing it as a negative. Adjusting the claim was $260,000, and most of our cost is there, and we're going to reduce that by 80%. So what's 20% of that? $52,000. We would save $208,000 by not adjusting those claims that are under $1,000 each. And we are not told that paying the claim would change at all. And so that would be a 0. And so the net savings would be $196,000. Estimate the average cost per claim payment, assuming that the changes proposed by management are enacted for 2,000 total claims. So we're now down to $304,000 for the 2,000 claims, or $152 per paid claim. We're saving almost $100 per claim. The one thing that is not taken into account here is there's no way we can do this in class, but the qualitative part of this is, did adjusting those small claims actually end up saving them money on the claims themselves? Not the work involved in processing the claim, but the actual claim. So if you filed a claim for $800, did it get adjusted to $700 and save you $100? It would have been worth it to adjust that claim. So we would need to take that into account as well. And I don't know if that's something this company could do before they actually implement this policy. It's possible that claims would start going up when it's learned that, hey, they're not adjusting the claims, they're just paying them. You might have more frivolous claims. You might have more claims that are inflated or unsubstantiated. And so those are the kind of things we definitely need to take into account. We can't for this exercise. We did exactly what was asked of us. But if you were the management of this company, you would definitely want to keep that in mind as you're making these changes, what implication that might have for the future of the business. So that is actually the end of chapter 27. Anyone have any, we're a little bit early, but does anyone have anything you want to talk about, ask about, questions from this chapter? Okay, I'm going to go ahead and stop the recording then.